All right, folks, good afternoon. I'm Charles Payne. This is Making Money. So the monster rally from May through October, folks, this is really, I mean, every single month the market was higher, and this doesn't happen a lot. You've heard the phrase, sell a man, go away. Not this time. Now, the 3 times it has happened before, it's really bode well for the market for the next 6 months or the rest of the year, rather. 6.5%, that's your median return versus 3.6%. So in other words, usually the market doubles what it normally would do with that kind of momentum. By the way, speaking of a coiled spring, look at this. The realized average stock correlation right now suggests, again, that maybe, even though we're up big, that this market may actually be a coiled spring right here. Of course, back in the day, let's just call it pre-chat GPT, everyone would have said, okay, if it's a coiled spring, let's go for the cheap stuff, right? You see all this stuff here in blue. These are your P ratios versus the S&P 500. They look pretty attractive, right? I mean, compared to the ones that are deep red, technology, consumer, industrials. But that's what I'm going to tell you. Those betting on rotation out of technology stocks so far this year have been disappointed. And I mean, big time. You've never really seen anything like this. The dark blue line, that's your tech names. The black line is defensive, right? And a lot of people were defensive this year, particularly in May and April. They have gotten absolutely crushed. Even cyclicals have not done that well, particularly compared to the big names. Now, the good news is that more companies outside of tech and communication services fall under AI. I mean, there are even more names than this. Morgan Stanley had 41. Jim Bianco's got about almost 50%. I guess at some point, every name will be considered to a degree an AI name. There's undoubtedly enough capital out there available to reach all corners of this market. Think about the announcements. Even this morning, another one. OpenAI turns to Amazon, $38 billion infrastructure deal. That's just the latest example. Now, my next guest is staying overweight in U.S. equities, in part because of the AI theme. I'm going to bring in now BlackRock, the global chief investment strategist, Wei Li. Wei, you know, in your note, you point out the CapEx spending, which everyone's kind of talking about. Now, for a long time, Wall Street kept saying it can't be sustained. It can't be sustained. It can't be sustained. This is Morgan Stanley going out to 2027, $700 billion. So almost everyone's kind of agreeing, okay, it's going to be sustained. We just don't know when. And for you, that's a main reason to be along this market.
Absolutely. I think this phase of AI build-out is becoming more capital intensive. So up until this point, those hyperscalers are paying for their capex from their very high level of free cash flow. But now they are having to dip into the credit market. And also some of the new entrants into the AI build-out are less cash rich. So they are also having to go into the credit market, private credit market, to fund their very ambitious capex spend. But the big picture remains that earnings are continuing to be very, very strong for these AI plus names. And we're still early in this AI transformation, which is why we're overweight.
How worried are you that the rally, though, has become even more narrow? I wasn't long ago where everyone was saying, okay, we'll start to see some rotation or the broadening of the rally. And that hasn't happened. It's actually gone the exact opposite direction. Does that bother you?
I think this is a feature of transformation. If you look at the U.S. growth picture, actually non-residential investment tripled in terms of its contribution to U.S. growth, driven by AI. So I think the narrowness of the stock market very much reflects the narrowness of the U.S. economy. And this reflects where we are in AI transformation. Maybe further down the line, there's going to be broadening out as adoption and productivity boost supports.
That would become sort of the buy recommendations later on will be maybe based on who's using or incorporating AI the best. But for now, AI is the theme. Stick with it. No need to get off this bandwagon right now. Another one of your tactical strategies, you like seeking alpha sources. What exactly, if you had to sort of articulate this in a more of a layman's term, what would it mean for the audience?
Charles, you actually started this segment with a great chart showing the stock correlation pairwise actually becoming very, very low. This is a great environment for seeking alpha. This is a great environment to be active. Just expecting rising tide to lift all boats is no longer the case. So we think this is a better environment than for a long time to be more active. And in terms of how we think about seeking alpha, you can think about it from a granular perspective. You can think about it from a relative value perspective. You can position for deregulatory kind of moves. And you can also think about kind of providing liquidity to market when there is stress in market. And if you're in the luxurious position to be able to provide that liquidity, which is kind of where we were back in April.
All right, now your strategic approach. This is, of course, more of a 5-year approach. Infrastructure, equity, and private credit. Let's just stay on private credit for a moment, because this has sort of been sending out yellow flags, maybe red flags over the last month or so. People are concerned. This is your wheelhouse of BlackRock. Is it concerned? How much should we be worried about private credit?
Well, we have seen some idiosyncratic default cases that represents a very small part of the private credit market, specifically in the receivable lending, which is very, very small part of that market. But more broadly, default in terms of notional is still very, very low. In terms of payment in kind and distress percentage, that's increasing. So that raises question about how lenders are lending when they are kind of in a hurry. But more broadly, we think this space is still very well supported by fundamentals, especially as we think about greater need for private credit to fund this huge transformation.
Right, and we just saw, I think, Google on Friday, or again, but they all are now going to the private credit markets, and to your point, that helps a lot. Where do you see the FOMC? How does the Fed play in all of this, particularly after that sort of surprising announcement or stance that Jay Powell took on Wednesday?
I think they're going to keep cutting. They're going to cut in December. And maybe they're not going to cut all the way to 3% by the end of 2026 as priced in markets. But for now, labor market is soft enough to support them cutting. And that is our expectation. Now, this idea, this comment by Jay Powell about December not being a foregone conclusion, he didn't really articulate a very good macro case for why that is the case. I think that very much speaks to the more complicated dynamics at the FMC rather than the broader macro backdrop change.
So maybe he was trying to soothe the few people within the FOMC, because it feels like there's a strong dividing line there right now.
I think so. I think that's what that means rather than the broader environment changing. So we still think that pro-risk being supported by Fed cutting is the baseline.
Let's talk about tracking 5 mega forces. I love this. I talk about demographics all the time. I'm really concerned about the whole fertility crisis, particularly in Western nations, digital distribution and AI, geopolitical fragmentation, the future of finance. Can we start with the future of finance? I feel like I see this reflected in the equity markets. If you look in the financial sector, the names that have done extraordinarily well this year versus names that have big moats like Visa and MasterCard, feels like there's a changing of the guard. What do you mean when you look at the future of finance?
We actually refer to private credit as we think about kind of the future of finance, as banks may need to kind of step away a little bit because of the broader regulatory environment, how private credit may have to step up to fill the void, the gap needed to fund the transformation. But as we think about future of finance, stablecoin also plays a role there. So the future of finance, the future of capital market globally is evolving, and they're really interesting investment tools to express our conviction.
Yeah, the stablecoin thing, I think, has really turned a lot of things upside down, and maybe the administration backing it to the degree that they do. Geopolitical fragmentation, what is that?
It's the idea that we're talking about an environment where geopolitics are playing a greater role in influencing supply chains. So this is actually playing out right now. If you think about the trade headlines, the rhetoric wants to kind of go further apart, but the reality on the ground is also that the global supply chain cannot be rewired overnight without significant consequences on the inflation front and access to critical
So essentially, you're saying this is not the death of globalism.
Maybe the rewiring, the beginning of rewiring of globalization. It looks a bit different from the globalization that we know, but it will exist in a different, slightly different form.
Demographic divergence, what's that?
Demographic divergence, actually aging population is the central piece in that, and specifically there is a DM versus EM divide there. So if we think about so far this year in terms of labor market, job creation, weakness in the US market in particular, particular, aging population played a big role there. So the break-even rate in terms of the monthly job creation that supports a wage at a level that is still well contained, that level has come down because of aging population. So all else being equal.
Do you worry though about it really upending though economies at some point, whether it's China, South Korea, Japan, even eventually in America?
It has significant implication to long-term productivity outlook, but then potentially offsetting that is the AI digital transformation. So what we could lose on the productivity front because of aging population could be offset, or maybe even more than offset, by the productivity boost from AI. But the jury is still out there, but for now we're still overweight AI for that reason.
In 2 words, industrial robots.
Yes, sounds good. Great.
Great stuff. Really
Thanks
appreciate your work always. Thank you so much.
Thank you so much.